Hello investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about Okta. So Okta is an identity management platform and it was a stock that was really favored in 2020, and as we look now, it's kind of fallen out of favor slightly with investors, and that's what piqued my interest here. So we're going to talk about its growth prospects. We're going to talk about the one thing that puts me off from this investment, which is profitability profile. Then we're going to talk about its valuation. So just going to jump right in, and it's quite interesting. So you can see here in the graph just how volatile these shares have been in 2021. I mean, when I was looking at this back in 2020 and then in July of this year, I was kind of thinking to myself, wow, this business is doing all the right things, and everyone was telling me, I don't understand this business, it's like gonna be growing at bananas rate, and I'm like, okay, fair enough, but the valuation kind of puts me off. And this is what I actually said back in July. I said, given that Okta's stock is priced at 32 times forward sales, new investors, as in me, to the stock will struggle to find enough of an edge that's not already priced in. And as you can see, since July the stock is kind of down, so it's an interesting valuation right now at this point. Okay, so here's the thing. So Okta made the acquisition of Auth0, and including Auth0, the Q2 results were really strong, 57% year-over-year growth. Okay, and they're going to report in the next 2 weeks, I think it is, or even next week, I can't remember now, their Q3 2022 results. Now, with that in mind, you have to think about it, right? So they, as a standalone business, they grew at 39%. Okay, so it's with that inorganic growth that they put out 57%. So investors are kind of questioning, okay, can the business really continue growing, the underlying, the core business, can it continue growing at such high rates? Okay, and for their part, management saying, okay, we are putting out guidance for over the next 4 years to grow at 35% compounded annual growth rate. So that really should be appeasing investors. Furthermore, the billings for the standalone on a normalized basis was up 47%. So billings is a leading indicator where revenue is going to come in, and with that in mind, billings remain strong. So there's a lot here to like about the business. Furthermore, it's recognized, both Okta and Okta, including Auth0, are both recognized as leaders by Gartner. So on all fronts, the business is performing really, really strongly. I like this identity platform. Also, you can see here the number of customers spending more than 100K or as an ARR, they call it annual contract value, was up 55% now, year over year. Now, remember, this is partially because of the Auth0 acquisition, but even if we go back to Q1, they were up 31%. So the number of customers reaching out is always a very bullish indicator for me. If the number of customers reaching out for a platform are growing rapidly, that's really attractive, and that shows the business is thriving. I always pay a lot of attention to what the customer or the user is doing, and with that in mind, you can see here it's up significantly. What's more, the net retention rate was 124%. So customers came in and the retention was up. So both very, very strong metrics. If you're looking at any sort of business, but particularly in the SaaS world, you would really want to see that retention rate around 110, perhaps 115, and at 124, it's like, yeah, no brainer. This has worked out really nicely. Now, one of the bearish things that I kind of look at, and it's like, okay, so for the first 6 months of the year, non-GAAP operating margins were negative 7%. This compares with negative 2% in the same period a year ago. Now think yourself, okay? Everyone told me, Michael, this is just because of the Auth0 acquisition and there's some integration costs going ahead. And I'm like, okay, fair enough. But why is it that looking out to the next quarter, the guidance points to negative 10%? So with that in mind, I mean, they're struggling to kind of really get that operating leverage working in their favor. Management says, okay, don't worry about it, because by 2026 we're going to reach 20% free cash flow margins. So obviously that's attractive. If you look at other businesses, even in the SaaS world, investors still very much crave to see those high free cash flow margins. It's not just investing for growth and incurring losses at any cost. Investors are really rewarding that. And you can see that in other names like, for example, Datadog, or even to a certain extent MongoDB. When there's a clear path to strong profitability, investors are rewarding that, okay? So here's the thing, right? So Okta is priced right now at 20 times forward sales. So you can see in this graph, this is the multiple and how it's oscillated over time. And you can see here that right now it's probably the cheapest price point that investors are going to get for some time. I mean, this is really attractive, I think, if you think about it. There's no... Relative to where it's been over the past year, investors right now are the most gloomy they've been for some time. So that's always a good entry point for people considering. As I said, compared to other hypergrowth companies like CrowdStrike, CrowdStrike hasn't done particularly well, but it's still priced at 27 times forward sales. But in any case, CrowdStrike or MongoDB is priced at 31 times forward sales, and both of these businesses are kind of be growing over the next year at 35% compounded annual growth rates. So in the case of Okta, it's supposed to be growing slightly faster than that, and it's only priced at 20 times forward sales. So I think with that in mind, I think that, you know, this probably is a good entry point as anyone's going to get. So I mean, there's a lot to like here. It's the valuation works. There's strong visibility. There's ample visibility, strong growth. You know, I'm just being nitpicking when I'm really looking at the operating margins here. I mean, I don't think it's a big thing, but I think that it's something. But yeah, so I tend to try and work a little bit hard, and I'll try and find something that really kind of like a no-brainer for me. So if you want to find out what kind of no-brain investments I'm looking at right now, don't forget to check out my marketplace. It's called Deep Value Returns. You can see what other people have said about in my reviews, and yeah, I'd really help you think through your portfolio and how to build a nice track record. Okay, thank you so much. Bye.